Good afternoon, good morning. Welcome to HYCM's Look Ahead webinar with myself, Giles Coghlan. Let me just go back to the quite correct slide. Okay, for some reason my slide is not, hang on, let me just change the screens around. I can see the problem. If you can just let me know you can see my screen and hit, there we go, we got there in the end. If you just let me know you could see my screen and hear my voice okay, that would be great. Hope everybody is well. Very good morning, good afternoon. Alexandra, good to have you here. Gavrel, good to have you. Kingsley, lovely. Setley, lovely to have you here. Farhad, Laritza, Mustafa. Yeah, good to have some good familiar faces here today. Big week for the pound. We're going to be getting ready for that, very much so. We've got Bank of England interest rate and the Bank of England inflation reading. Going to be hugely influential for UK yields and the path of the pound moving forward. Now, looking at the calendar, just as folks are coming in, don't forget, as we look at different entries, exits, the whole idea of this webinar is that we're looking from a educational perspective. It's not a signal trading service or anything like that. It's an educational perspective. You look over my shoulder and see how I go about preparing myself for the coming market moves. Now, what we're going to be looking at for the Wednesday workshop, which is this time on Wednesday, is how to trade the Bank of England meeting and the Swiss National Bank rate decision. We'll touch on that today, but we'll look at that also in much more detail on the Wednesday. In terms of significant events, it's going to be a big week for the pound, and it should be a big week for gold as well. So just as we're getting stuck into this session, I want to get us ready and understand what the major narrative is really in the markets. Now, if you take a look at stocks generally, and if we just zoom out to the weekly chart, what you'll see is that stocks have been rallying quite hard over the last few weeks. You can see here S&P 500 rallying week after week, the Dow, Nasdaq on a strong surge higher. All of that has been on the artificial intelligence attraction with big companies that are exposed to AI. A lot of investors seeing a productivity jump, and there's a lot of excitement, and there's been a mini sort of bubble in artificial intelligence stock recently. And you can see how the Nasdaq has been rising much faster than the other indices in the US, and that's because of the technological exposure of the Nasdaq. And markets at the moment are kind of in two minds, because in one sense they're thinking, okay, yeah, there's been some nice rallies in stocks, but is this an overbought situation? And the path rate of interest rates is increasingly uncertain. If you just take a look now at the Federal Reserve, you can see that short-term interest rate markets are expecting interest rates to sort of stay at current levels roughly until the end of the year. Now, the inflation and labor data, we know from the Federal Reserve last meeting, will be absolutely crucial for the path of US interest rates. So that will be a huge influential series of data points that we've got. So inflation, PCE, labor data, and remember, labor is inflationary. If you've got a good labor market, that's inflationary. If it's a weak labor market, that's deflationary. And interest rate markets and the dollar and the yields will be moving in line with that. Now, this recent rally in stocks is just sort of a pause today. US is on holiday, but it's just hard for these markets to keep rallying. And the reason is, if you look at bond yields, you can see as you look around, these are some quite attractive yields now. US, you got 3.76% on 10-year treasuries. In the UK, you got nearly 4.5% in a UK bond. So that means you can get, nearly 4.5% interest essentially by lending money to the UK government. And If bonds get more and more buyers, we'll see the yields fall. And say yields fall down to 3.5 or 3, you get not only the yield, but also the capital appreciation as well, as the value of the bond moves inversely to the yield. So when the yield's going up, that's the price of the bond is going down. When the yield is going down, the price of the bond is going up. So if yields start dropping, then the price of the bond increases. So looking at these yields, eventually investors are going to say, well, have Western central banks peaked their terminal rate? Will they be starting to think about cutting interest rates? If they do, these yields suddenly become really attractive at these levels. Now, at some point, my opinion is that that's going to happen. And when we start to see bonds becoming more interesting, then equity markets are likely to fall, particularly around this half of the year, because the portfolio managers tend to rebalance their portfolios each quarter, halfway through the year. And with such a strong rally in equities, there's probably a proportion of portfolios that need to be rebalanced in favor of bonds. And bonds, personally, I do have a long bond position because I'm finding bonds attractive at these levels, and I think other investors will find that too. So if inflation peaks, then these yields will drop lower, and that's the sort of what my view needs to see. But if inflation keeps rising higher and higher, then the yield can rise higher too. Okay, so understand that. So that's where we are in terms of the big picture. Now, in terms of the calendar, we've got some pretty significant events. So the US is on a public holiday, very quiet data today. Just it's one to knock off the radar. There's not much going on. The other thing to be aware of is what's going on in gold. Now you can see that US 10-year yields, right? They've sort of been moving lower and lower, broken out that recent range and struggling to get above that region. Now, if yields start falling, and if that starts happening the same time as gold starts falling, and we can see gold has seen dollar's seen some sellers. So if we see that yields fall lower and the dollar fall lower, that should be upside for gold. So I'm looking very carefully at gold. On the weekly chart, I see some very, very interesting things. So I see here a false break of a inside bar. This is a Hikaki pattern. Do you see how you have that inside bar pattern? You've got this symmetrical triangle, you have a false break to the downside, and then prices snapped higher. That typically is indicative of higher prices. Now you see here we've got a big overhead resistance area just around this region, 1916. Prices threatened to break down, found buyers, and snapped back into the pattern. So I'm expecting price to move higher out of this. And if yields move lower and the dollar moves lower, that typically supports gold. So for me, gold is a good value buy at these current levels, and stops for me can be placed just underneath that 1920 region. Okay, that looks pretty good value for me. And looking for a breakout of that region. On the weekly chart, we can see we've got a potential triple top, 1, 2, 3, but price wants to go up and have another go at that. And if we break through that level, then we're up to 2-1, 2-2, 2-3. Okay. The environment for gold is very attractive. What is the environment for gold? Well, the environment for gold is yields lower, bonds potentially, bond yields lower, dollar lower. That should be upside for gold. So keep an eye on gold. It's a great place you can define limit risk. I'd be super interested if price had moved down to that sort of 1900 region here, 1850. Sorry, no, if I go to the daily chart, you're seeing 1900 here on the daily chart. That would be a super interesting level. But this is good enough in my book. And the weekly chart shows that we've got that false break pattern. Okay, and I'm looking for a move up to there and then ultimately to break through that level in line with what's going on with the yields and the dollar. But that view for me is dependent on the US 10-year yields falling, so peak inflation, and the dollar falling. Right. Now on Tuesday, we've got another pretty quiet day. Some PPI data out of Germany for some European inflation. The inflation outlook in Europe is as follows. that the ECB are expected to hike in July, and then they're data dependent. So one more interest rate hike is expected for July. You can see here, current rate 3.5, terminal rate is around 3.81%. So they're expected to hike by 25 basis points in July. And then the ECB have told us they're going to be data dependent. So what that means is if the PPI data comes in a big miss, then there'll be less likelihood of the ECB hiking beyond July. So keep an eye on that for the euro. Now, we've then got a number of Fed speakers. We know the main narrative of the Fed. They've essentially moved to a more data-dependent stance, and they're happy to not hike anymore as long as the data doesn't indicate that more interest rate hikes are needed. As long as labor's getting a bit of a looser, so a weakening labor market, falling inflation, particularly the core PCE print, and that would mean yields lower, dollar lower, gold up. So watch out for Fed speakers, though we're pretty much sure of what they're saying. Wednesday, this is probably the most influential data point of the week. And what's happening here, right, now follow this closely. UK headline inflation is due to come in at 8.5%. Core inflation is due to come at 6.8%. Now look at this. Right, core inflation in the UK is very sticky. Do you see that big jump higher? Now compare the inflation around the world, and you'll see that in the G20, the only inflation, core inflation that's higher than the UK in the G20 is Brazil, Mexico, Turkey, and Argentina. There's clearly a problem in the UK. Bank of England's very worried about this. That was what sent UK gilts surging higher last week. Everyone's talking about bond yields going higher in the UK. Look at those 2 years. The 2-year bond yield now is nearly 5%. So you could go and buy a UK gilt, right, and get 5% yield. Fantastic, right? Now those yields going up and up. Why? On interest rate expectations, because the markets are now expecting the Bank of England to hike 5 times, right? Up to 5.78% as of this morning. So that's 5 times 25 basis point rate hikes expected. So huge amount of hikes are expected. Now, what will confirm that? Well, that's very hawkish. It'll have to be high inflation. So the core inflation. Now, if the core inflation comes in above 6.8, 6.9, and the headline comes in 8.8, the maximum expectations, that will confirm that hawkish print. I'm not interested in buying the pound. Hawkish pound was last week's trade, right? I'm expecting now the best opportunity to come from a miss in the data. If the core inflation comes in below 6.5% and the headline comes in below 8%, I expect the pound to sell off very, very quickly. And if you just take a look at the pound dollar, you can see, look, over the last 15 years, the Bank of England, right, you've seen interest, you've seen the pound dollar fall, okay, nearly 80% of the time when the Bank of England have hiked interest rates. So, right, there's a predisposition for the pound to sell off against the dollar. So what I'm looking for to sell the pound against the dollar on Wednesday is something very particular. What I want to see the core below 6.5, headline below 8, and then I'm looking to sell the pound dollar in line with those weak seasonals, right? Expect the pound to lose value, because then running into that, ECB speak, Fed speak, we know what to expect there. We know what will trigger moves, but I'm looking then to the Bank of England interest rate decision on the Thursday at 12 o'clock. So we know the pricing for the Bank of England, and the pricing is really aggressive. We've seen it, haven't we? Look, expecting 5 interest rate hikes, 75% chance of a 25 basis point, and a 1 in 4 chance of a 50 basis point rate hike on Thursday. If, right, and this is if the inflation print is a big miss, as I've outlined, then the Bank of England would need to do less in hiking interest rates. So that would be pound weakness. So the best opportunity of this week we'll be looking for an opportunity to sell the pound, in my opinion, if we get the core inflation coming in very low. Watch for this. I've been informing my media contacts about this, getting the word out. This is going to be a huge 24 hours, 30 hours for the UK. Okay, massive. And that recent move higher that we've seen in yields, if the inflation is a big miss, core inflation a miss, headline a miss, this will just rapidly go lower, and people will be locking in that yield saying, great, the UK, the Bank of England has peaked. And there's been lots of chatter that, you know, look, the Bank of England's up to those distressed bond levels that we got. The difference is when we got to that level in September, that was on the uncosted mini budget, disastrous budget from Liz Truss's government, the UK Prime Minister, for about 6 days. But it went aggressively and disorderly. So the difference now, yeah, we're high now, but it was the speed, the disorderly nature. It was a very frightening kind of surge higher that the Bank of England had to step in, right, to stop disorderly moves in the UK bond market. But that's where we're at. Okay, that's the issue. So then, before then, we had the Swiss SNB interest rate decision. Now, the recent Swiss inflation data has been reassuring. Okay, we saw that UK inflation data was not reassuring, but look at Switzerland. The last print was 1.9% for the core. That's like below 2% target, right? The headline dropping again, 2.2% for May. So inflation in Switzerland is not too bad. I know it's all relative, but look, the only other country with lower inflation than Switzerland is China. Okay, so the headline is really quite good. The core is also really quite good. You look at the core, 1.9%. Which other countries have higher core? Only China. So Switzerland has been doing well. Now, Thomas Jordan, the Swiss National Bank chair, was making some pretty hawkish comments last week about the Swiss franc, but that recent gain we've seen in the Swiss franc looks vulnerable to me, right? We did see a lot of gains in the Swiss franc over the last few weeks, but you notice here we've got like this little breakdown that tried to happen last week, and I wouldn't be surprised if we saw further Swiss weakness. So watch out on Thursday morning that the Swiss National Bank don't surprise markets and hold interest rates. Now, what they're expected to do is they're expected to hike, and the hike that's expected from them is a 50 basis point hike. Look, 58% chance that they'll hike by 50 basis points and 42% chance they'll hike by 25. So if they don't hike at all, you'd expect to see the Swiss franc sell off rapidly. So if there's no interest rate hike, look for Swiss franc weakness, and I'd probably trade Euro Swiss franc upside on that, and maybe have a little check close to the time to see what is going on. Now, then we have some more ECB speakers coming out, and then Friday we have a collection of PMI data points coming out. Now, the UK retail sales is also due. Now, if we had the missing inflation on Wednesday, and then a dovish Bank of England on Thursday, and then that's a miss on Friday, we'd likely to see pound accelerating into the end of the weekend, but we'd need to see all three of those happening. Okay. Friday, series of European PMIs, very, very important for the Eurozone. Now, recently in the Eurozone, if I show you this, it's been similar around the world, that in terms of PMIs, we've seen a difference between services PMI and manufacturing PMIs. You see the manufacturing PMIs, to see how they've been like in contractionary territory, 48, 46, 45, 44, but the services PMI has been sort of quite high. So what the thing to look for here is if we see a big miss in the services PMI, that's the bit to look. Services. So if we see a big miss in the services PMI across the board, and it starts with the French data, then I expect Euro weakness. So look out for that. A big miss in the services. Manufacturing's weak anyway, but a big miss in the services will start to make traders think, oh, okay, maybe the ECB doesn't need to hike beyond July. That's kind of what short-term interest rate markets think. But if it's a very big miss, maybe they think, well, they won't hike at their next interest rate meeting in July. Maybe they won't do that. So that's the way to look at that data on the Friday. Right, I'm just going to see a question here. Yeah, question. Gabriel says, when do you think the Bank of Japan will stop yield curve control policy? Gabriel, a great question. Now, if you look here, right, you see that December 20th, we saw this huge surge higher in Japanese 10-year bond yields. Now, prior to that, the Bank of Japan said, we are keeping bond yields in between plus 0.25% and minus 0.25%. So what the Bank of Japan has said, we're gonna buy bonds every time it gets up to this level. We're gonna buy them, come what may. We're gonna buy an unlimited amount of bonds and artificially keep the yield low. Interest rates are still negative in Japan. Japan is keeping a negative interest rate environment, contrary to almost every other country in the world. So what Gabriel's saying is, well, when will they stop this? And when they stop this, and say they stopped it today, said, oh, well, that's it, that's the end of yield curve control, what will happen to the yen? The yen will gain rapidly. So a lot of traders, investors have been trying to bet on when the yen will gain rapidly as the Bank of Japan end their yield curve control policy. And here in December 2020, they tweaked it from plus 0.25 to plus 0.50. Right, and that's when traders start thinking, aha, they're going to change it, they're going to change it. And we started seeing the bond yields push higher up to that level, thinking, will the Bank of Japan end the policy? They have been stubbornly stuck on it. So what Gabriel's saying is, when do I think they will end? I had an attempt at buying the yen earlier in the year, in line with weak seasonals, which saw yen strength, and I got stopped out, lost about 1.7% on that position. Because I was trying to position myself ready for this. So when is it likely to happen? That's the big question, and it's very uncertain. Okay, we don't really know exactly when the Bank of Japan will end its yield curve control policy. Now, what I can do is give you my opinion. My opinion is this, Gabriel, is that when other central banks have definitely reached peak terminal rate, I think that's when the Bank of Japan will have some confidence. They'll think, okay, now we know at least how high yields are likely to go, so we can start allowing our yield to move higher. Once the Fed, the ECB, the Bank of England, the RBA, the RBNZ, the Bank of Canada, once they've announced sort of, they're not hiking at rates anymore, I think that will give the Bank of Japan some confidence. So it's not a high conviction, but that's my opinion, right? And I would say that would likely be around September time this year. But that's a guess, and it's my opinion. And I said, I'm not trading that, because I can see that the Bank of Japan, maybe they'll hold up for another year, for 2 years. They have defended this level, strongly, and betting against them without limiting risk very carefully, it seems like a loser's game to me. But even though, Gabriel, eventually I'm expecting the yen to strengthen. Now, what ways can people express that? If people took like an option, if they bought like a call option on the yen, for like a 12 months time or something, I'd expect that to be in the money. But again, there's risks with all these outlooks, and there's risks with every position, the situation you take. But I would expect the Bank of Japan to end their yield curve control policy once other central banks have reached peak terminal rate, and I expect to happen as soon as 3 months and as long as a year. Gabriel, that's my opinion, but my opinion could be wrong. It really could. So but that's my best assessment of it. Yeah, no worries, thanks. At least you can see my logic and my thinking, okay? And whether that comes to pass or not. But as I said, it's not something that I'm investing in. Whereas like gold longs, I have much more conviction on, and I think, okay, yeah, I'm investing in that and I can define my risk, and I'm really looking for gold to take on new highs. That's not trading advice, not investment advice. I'm just telling you what, what I'm doing and how I'm trading my capital. Okay, folks, it's been a pleasure as always. Don't forget, we are intending to be back here on Wednesday for the workshop, and on the workshop we're getting ready for the Bank of England and the Swiss National Bank decision. I'll show you exactly how I'm trading that, but you know what I'm doing with the inflation print. If that inflation print isn't a miss, then I won't be trading that, but I will still have another opportunity for the Bank of England decision. I hope you take care and have a very good rest of the session. Thanks everyone now, and goodbye.